Hello again. Today the focus of our will be inventory and some of the complications in accounting for inventory and the resulting cost of goods sold. When we talk about inventory and the accounting for inventory, we naturally are also discussing cost of goods sold. Because when inventory is sold, then the cost of that inventory becomes the cost of goods sold, reflected on the income statement, having probably the most significant effect on our profitability as much as any other cost or expense that we may incur. Accounting for inventory perpetually means that every transaction involving an inflow and outflow of inventory is recorded as it happens with a debit or credit to the inventory account. As a result, the inventory account in the general ledger will maintain a running balance of the amount of inventory on hand at any point in time. Now, some things to note. Let's take a look at the basic transactions affecting inventory. First, there's the accounting for purchases of inventory. And again, when we purchase inventory, as we've done in the past, we simply debit inventory and credit cash or accounts payable if we are not paying cash at the moment of purchase, but we'll pay it in the near future. And the second entry is when we sell inventory. And the accounting for the sale of inventory is typically reflected with a debit to cash or accounts receivable and a credit to sales revenues for the sales price of the inventory. We also typically credit inventory and debit cost of goods sold for the cost of that inventory to us. And the difference between the sales price and sales revenues and cost of goods sold is referred to as our gross margin or gross profit in the transaction. Now, this is the way we account for transactions typically today on a perpetual basis, but it is not the way it used to be accounted for before the advent of computers. Let me kind of describe that. In the past, before we had more sophisticated computer programs and equipment, we could always account for purchases of inventory, that first entry that we've discussed here that affects inventory, because even without computers, when we buy inventory, we're going to be cutting a check and crediting cash or accounts payable. And so it was easy to identify the amount of inventory that we were purchasing simply by looking at some purchasing invoice or acknowledging how much cash we were actually going to pay. In the second part of inventory transactions, where we sell inventory, even before computers, the first part of this entry was easily identified, the debit to cash and the credit to sales revenues. And as a result of going into the files immediately and accessing that data for that particular product, not only can an entry be made by the computerized system to debit cash or accounts receivable and credit sales revenues for the sales price, but also to credit inventory and debit cost of goods sold immediately for all of the goods sold, identifying each item of inventory that's sold specifically. As a result, we can perpetually account for inventory, and within the computerized system, look at each and every inventory item and the accounting on a perpetual basis to determine how many units we actually have on hand. One of the things to note is that most perpetual inventory accounting systems utilize a subsidiary ledger. Not only do we need to keep a total general ledger account of all of our inventory, but it's also necessary and quite important for management to keep track of the inventory items item by item in detail. Not only to just keep track of total inventory, but to identify each item, each element and the different brand and size. We might have a different account, and every single time we have a transaction involving our inventory, whether we're buying or selling inventory, not only will the general ledger need to be updated by the computerized system, but the subsidiary ledger identifying each item of inventory will also need to be updated. This is the information, this subsidiary ledger, keeping track of each and every single inventory item that we have, that becomes so valuable to management. It is this subsidiary ledger that really tells management how many units we have on hand without us having to go out and actually count it. In fact, we can program the computer to identify when we need to purchase more. In this way, we're able to manage and control our inventory so that we make sure we have enough on hand for our customers, but not so much that we have it overstocked, more inventory than we need. And this can all be done by properly programming a computerized system. In addition to that, these computer systems of today can do some really remarkable things. For example, one of the things that's most difficult to managers today is managing our levels of inventory relative to inventory that tends to be somewhat seasonal. This kind of intricate management of inventories requires that you have a perpetual running record and that is being updated with each and every sale so you can see how sales are going and whether or not you need to start making even greater discounts in order to unload that inventory. Another interesting application of this kind of perpetual inventory accounting and the information that can be gleaned from it is that it can kind of help us to understand interesting geographic and demographic trends relative to our sales. From a management standpoint, in terms of making sure we've got the right inventory in the right places to fulfill our customer needs, this kind of perpetual accounting can render that kind of information that makes us more effective managers. Was that these kinds of perpetual inventory systems can also help us to identify relationships between different products purchased by similar customers. You can see how these kinds of new, sophisticated computerized systems that are identifying the inflows and even more specifically, all of the outflows of inventory, even customer by customer. Not only does it keep some perpetual running record so that we don't have to go out and count the inventory to determine whether we're going to purchase it, but it can also provide tremendous information that can be available to managers to make them more efficient and effective in trying to operate their stores more profitably. Was that these kinds of perpetual inventory systems can also help us to identify relationships between different products purchased by similar customers.